Hello, I'm Winston, and welcome to the Real Estate Template. We are here to talk to you about real estate investing. I want to talk to you about buying houses, buying land, buying buildings, apartment complexes, and teach you ways to understand your numbers and teach you ways to understand your project, because there's so much more to just buying it and holding it and waiting for the money to come in. I want to teach you how to invest in it and how to make it make you money. That's our goal here with the Real Estate Template, is to make you money. So we're going to start off today with running some numbers. We're going to talk about, if you don't run your numbers, how do you know that you know that you know that this project is going to be profitable? You have to first know how to run your numbers. If you fail in running your numbers will fail you. They will not fail you every single time. I think for the last 10 years, you could throw a dart at a dartboard, anywhere it's stuck, you could invest there and you could make money. Times are changing. We're going into 2023. It will not be the same world. It will be different. So we have to make educated guesses. We have to understand how we're going to invest, and we have to understand how we're going to make money. When you run your numbers, you are not stressed out. You don't go home all stressed out. You don't fight with your wife when you get home because you're stressed out, or your kids. When you know your numbers, no matter what, you know your worst case scenario and your best case scenario, and you have evaluated both scenarios, and you can live with either one of them. If you can't, then do not do that investment, because there is always a probability that the worst case scenario could turn up. So always recognize that. What we're going to talk about today is a cap rate. So what a cap rate is, I'm going to read the definition, then we'll talk about it for just a second. So a cap rate is the real estate valuation measure used to compare a different real estate investment. Although there are many variations, a cap rate can often, or is often, a ratio between the net operating income produced by your asset and the original capital cost of the asset. So basically, we just want to know how much money you're making on a yearly basis on this particular investment. If you take your money and you invest your money into the stock market, and you get your sheet at the end of the year and your sheet says that you made 8%. Okay, you put $100,000 in it, you made $8,000 off of that investment that year. That number fluctuates back and forth, back and forth. Real estate's a little bit better, a little more consistent. It doesn't fluctuate as much. I'm not going to say it doesn't fluctuate at all, but it doesn't fluctuate much, and most of the time when it does fluctuate, it's going to be in your benefit. So we will discuss cap rate today. On the next episode, we'll bring it in and talk more about cash on cash. When you invest in a property and you use the bank's money and all you have is a percentage of your money in there. That'll be the next episode. So today, we're going to start off with going out and we're going to purchase a home, and that home we purchase is going to be worth $200,000. Or maybe it's what you're paying for, $200,000. Maybe it's worth more. Hopefully it's not worth less. So we're going to go out, we're going to buy a home, and we're going to pay $200,000 for that home. Our next thing we need to think about is closing costs. So we're going to say 3% on closing costs. Now that's something, as you go and put a piece of property under contract, you want to talk to whatever title company you use. You want to find out, hey, what kind of percentage am I looking at on closing costs? Closing costs are sometimes less than 3%. Sometimes they're a little bit more than 3%. You have to determine that. You cannot just go off of 3%. So that is something that you will figure out as you go out and do your evaluations. You will know what that is. So what are closing costs? So closing costs are attorney fees. So whenever you go to close things, we have attorneys involved in getting the paperwork together for you. We have attorneys involved in doing title searches. You want to buy a piece of property that has no liens on it. It doesn't have any easements in it that you're unaware of. It doesn't have any problems. And that's what these attorneys are going to find out. They're going to find out if there's any problems. So you're going to pay for that. We're going to have origination fees. So origination fees are what the bank's going to charge you to do what they got to do. So you're going to pay a fee for that. If you're going to buy a house, you may use a prepaid interest. So let's say that you're going to buy it at 6%. But you don't qualify at 6%. You qualify at 5% with your mortgage company. If that's the case, you can buy down 1% from your bank, and they may charge you 1% to do that. If it's a $100,000 loan or a $200,000 loan, as we showed here, then they may charge you $2,000 and say, I will let you have it for 1% less with $2,000 up front. So that is what prepaid interest is for. Escrow deposits. So as you do a home, or a building or whatever you're buying, you got to pay property taxes. You got to pay insurance and different fees. Maybe there's HOA fees. And maybe the bank says, we're not okay with you paying those. We want to pay those. So the bank collects that money. The bank puts it in an account. And the bank uses that money to pay your fees throughout the year. So that is what an escrow deposit account is for. You're going to pay your county or city clerk a recording fee. You're going to pay somebody to underwrite it and guarantee your deal. They could be property taxes that are due at the time. You're going to pay for insurance, and you're going to pay for a home inspection fee if you get a home inspection fee. And there could be other things that you pay for. But that is what goes into the closing cost. So this is just an example of some of the things in the closing costs. There are more, and sometimes there are less. So we go in, we buy a house, we pay $200,000 for the house. We're going to estimate the 3% on the closing cost. So we got $6,000 on closing costs. Now I look at the house and I say, man, for this house to really rent what I wanted to rent for, I got to do some repairs. Maybe you need to put a new kitchen in it. Maybe you need to put a new bathroom in it. Maybe you just need to put some flooring in it. It doesn't matter what needs to be done to it, but you need to figure in 100% of the money that it's going to take to bring that to value for you to do the investment and rent it and make the profit. If you don't take everything into consideration here, you're going to cheat yourself, and you're not going to make the money that you think you're going to make off of the deal. And I talk to people all the time who say, I only got $100,000 invested in this and I'm making 15% a year off of it. But really, when you look at it, they don't calculate all of their numbers. So they're lying to themselves to convince themselves that they're making more than they're making. Don't do that. Don't lie to yourself. It doesn't profit you at all. Do your numbers honestly and run them honestly. So we're going to figure in $48,000 for repairs, which is going to give us $254,000 in the actual all-in money for this particular project. Now, I left one figure out of this that should go in if you're going to have a piece of property that you're paying a note on. We haven't gotten there yet. But there's carrying costs that's involved in this deal also. So I buy this deal, $200,000. I invest $48,000 in repairs. The repairs take me 2 months. I could have 2 months worth of utilities. So 2 months of electric bills, 2 months of water bills, 2 months of insurance, 2 months of other fees that I'm paying just to carry that property till I put a tenant in it. So those fees should be included. I'm going to say that mine are included in my $48,000. But carrying costs is something we'll get into in the next video a little bit more, because it becomes extremely important whenever you're doing this right here and you have a note on it, because now you got $1,000 a month note you got to pay while you're holding it, and that makes a big deal. You carry that note $1,000 a month for 3 months while you're trying to rent it, this number goes from 48 to 51,000 quick. So you pay attention to that right there, and don't ever ignore that fee. It's important. So now we're going to talk about return on investment. So your return on investment is the total cost of your property, every single penny of it, your rents, which equals your income. So you collected $12,000 this year, $1,000 a month. That's going to be your rents. Your total expenses on that property. You're going to take everything that you have as an expense, your insurance and your taxes, everything you pay for on that property is going to be included in your rents or in your expenses. So you're going to take your rents, you're going to subtract your rents from your expenses, and this is going to give you your total cash flow. Cash flow, income minus expenses, gives you cash flow. That's also known as net operating income. Let's stick with the word cash flow. We're going to use that right there. So your cash flow or your net operating income divided by the cost of your property will give you your return on investment. So that return on investment will be the same thing as we talked earlier, if you invest in the stock market and you get an 8% return, that's what this is going to give you right there. So that's going to be our return on investment. So now what we're looking at is we have $254,000 that we invested in buying the property. That's our repairs included, every penny of it. We're going to rent that house for $2,500 a month, which is going to be $30,000 a year. So you're saying, well, do I just pick a number out of thin air for that? How do I find out that I'm going to rent that for $2,500 a month? We don't buy a property and just say, I'm going to rent it for $2,500 a month. We buy a property and we know exactly what that house is going to rent for or that property is going to rent for when we buy it. There is no guesswork, none. If you're guessing, you're setting yourself up for failure. Do not guess. So how am I going to find what that house should rent for? One of the first places I'm going to look is I'm going to go to different apartment complexes' websites. They usually post it on the websites. Or I will call the apartment complex. If they have an 1,100 square foot unit and it rents for $1,500 a month, then I would say if I have an 1,100 square foot house, it should rent for at least $1,500 a month, given the fact that it's in the same school district, that it's in the same city, that it's not on one house is, the apartment complex is in a great area of the city, then you buy something that's in a bad area of the city. They won't rent for the same money. You got to compare apples to apples. There is no guesswork. You can look at the house, and if the apartment is 1,000 square foot, you can divide that by whatever the rent is, or divide the rent by the square footage, That's going to give you how much it's going to cost you per square foot. Then you got something that is maybe 500 square foot more. You can still use that number that you got when you divide the square footage price out. You can use that and multiply it times 1,500 square foot rather than 1,000 square foot. So another area I'm going to go to is I'm going to go to Zillow.com. You pull a house up on Zillow.com, they're going to give you what they think that house is going to rent for. And they do a lot of market research to come up with these numbers. So there's not a lot of guesswork in it. You can go to rent.com. You can go to redfin.com, realtor.com. Go to 3 or 4 of these different websites. Look at the houses that are right there in that area. They're going to tell you what that house is that you're buying is going to rent for, or what their estimate is it's going to rent for. And they're also going to tell you what everything in that area is renting for. They do market surveys to verify that they're right. I'm not saying they are 100% right, because they are not 100% right. There is room for error, so you have to use a little bit of common sense. But that is your homework, to verify that your market rents are exactly what you think they are. Double check it, triple check it. So we know we got the $2,500 a month. We know we're going to make $30,000 a year. So now we need to figure in vacancy factor. What is vacancy factor? So vacancy factor says I'm going to factor in that every so many months that property is going to change renters. So in my scenario, I'm using a 7% vacancy factor, which is 1 month every 14 months. I think that's very conservative. For what we do and where we invest, that is way, way, way conservative. We don't rent like that. We usually get at least a couple of years out of our renters. But this is a number I can live with, that if it happens every single time, I got it covered. So what the vacancy factor is telling me is that I need to figure in $2,100 a year, which is not quite the $2,500, because this is using 14 months instead of 12. So I'm going to figure in $2,100 a year that I may have to come out of pocket to pay for the note or to take care of that property so I don't lose any rentals. So as I do my numbers, when I put this in there, then every year I'm going to take $2,100 out of my investments. I will divide it by 12 months and I'll put it in a different account every month for the 12 months, so that when that property becomes vacant, I'm not sitting here wondering how in the world I'm going to pay the note. I'm going to pay the note because I've collected money month after month after month to make that happen. I would never use a vacancy factor less than 7%. If you are a new investor, I would use a vacancy factor probably around 10%, because if you don't know your market, 10% is a good place to be. It's going to be a little bit safer than the 7%, but this is a unique number for your investment area. Never go under 7%. So our vacancy factor, once again, the purpose of that right there is so that I can put cash back on a monthly basis that will cover the note and the expenses of that property when I change from one renter to another renter with a 1 month turnover. If you figure it's going to take you 2 months to turn the property over once every 14 months, then you got to double that to 14%. You got to be very efficient or proficient on this as you're doing it. So we got our vacancy factor. We got our total revenue at $27,900. So we got our income we're bringing in on a monthly basis is going to give us $30,000. We're going to take our vacancy factor, $2,100. That's going to give us $27,900. That's what we're going to use for our calculation of income. That takes into worst case scenario for this particular property for me. This is my property, okay? That is what's the worst case scenario in my opinion. Next, we're going to start looking at what expenses we're going to have on a yearly basis. I do not have the vacancy factor under expenses because vacancy factor may happen and it may not. You may go 3 years with the same tenant. I would continue to put the money in the account and hold it in the account for later, because you never know when you might need it. To have a little extra money in your account is always going to be a good idea. So we're going to use a property management company. And you say, well, I'm not using a property management company. I'm going to manage this property myself. I manage my own properties. I don't use a management company. I own a management company. So for me, I don't have to put this in my numbers, but I put it in my numbers. And you should put it in your numbers, because what happens if something happens to you and your spouse has to take and manage that property? Maybe the spouse doesn't have the ability to manage the property. Then the property goes downhill. They need to be able to turn it over to somebody to manage the property to still make money if something happens to you and you can't do it. What happens if something happens to you and your partner? Now your kids have to deal with it. Let's leave them something that we know. They can turn it over to a property management company. A property management company can manage it, and they can still make money. So I figure in an 8% 8% property management fee That comes to $2,232 a year. That is going to be an expense, which as we calculate down, it will come off of our total revenue of $27,900. Next thing I'm going to look at is insurance. Insurance is what insurance is. You can call your insurance company, whoever does your insurance. You can say, hey, I'm buying a house. This is where it's located. This is the size of it. Can you tell me what my insurance is going to be? They will be able to tell you what it's going to be, or roughly close to what it's going to be. You can put that number in your calculations. Next, we're going to look at property taxes. You can go on a tax assessor's website and you can look at property taxes. And you can say, they're paying $2,400 a month in property taxes, so I'm going to pay $2,400 in property taxes. Well, that sounds good, but that is not reality. So the reality is, if they paid $100,000 for this property and they're paying $2,400 in property taxes, and I give them $200,000 for it, my property taxes are going to double. My property taxes are going to go up in proportion to what I paid for it. So when your tax assessor sees that you just bought a property and that property was for $200,000, $400,000, $500,000, they are going to assess your property from that point forward off of what you paid for it, because they're going to say that's market value because that's what it was bought for. So when you look at taxes, figure out how they do their calculations for their taxes. And then once you know how they do their calculations for the taxes, you calculate your taxes based off of what you're paying for that property to give you a good property tax number. So don't just think you can use what was there, because you can't. Next, so we're going to talk about maintenance fees. A maintenance fee, you say, well, I don't think I'm going to have a whole lot of problems with the property. Do not do that. That property is going to need some repairs. Somebody may call you. They may say, hey, I got a sink leaking. You may say, well, I'm going to go fix it myself, which is great. Go fix it. That's not a problem, but is your time for free, or is your time worth some money? If your spouse has to manage the property, are they going to go fix it themselves, or are they going to call a maintenance company to go fix it? Always put maintenance experience or expenses in there. So you want to put maintenance expenses in there, and you want to look at the area that you're investing in. I'm using $500 because I know my property and I know that it's a newer property. It's not going to have a whole lot of issues. If you got an older house, it's going to take more than $500 a year to take care of it probably. If you have a trailer in a trailer park and you're just renting it out, you can expect your maintenance costs to be a lot more. A lot depends on the type of person you rent to. A lot depends on the area that you're renting in, the condition of the home. You got to take all that into consideration. But this maintenance number needs to be a true number, not just a number you throw out there and you say, well, I'm going to do my best to knock it down as much as I can, so I'm going to do $200 in maintenance fees. I'm going to eat my labor. I'm going to make this work. If you can do that, that's fine. But do that and let your cap rate show a lower cap rate, and you say, I can live with that cap rate. We'll talk about that a little bit more in a minute, but these numbers are true numbers. So now we have legal and accounting. Okay, what's that? So when you turn in your taxes to your accountant, the accountant is going to charge you. They may charge you $50 more for that one piece of property, to throw it in there and calculate the cost of it, calculate the expenses of it. They're going to cost you something. I use typically about $150 a property a year is what I use that my accountant's going to cost me. I want them to spend some time on my property because I want every expense taken out of it. I want to be able to write that off on my taxes. I want my true returns to be my true returns. That way, whenever you're doing a deal and they want you to give them audited financials, which I just went through here recently where they needed audited financials to do a deal for me, when they go in and do them audited financials, they need to match everything else. Be true to yourself. So if I'm going to use $150 for accounting them, I got $400. Am I putting the rest of it to legal? Yes. So between the two, I use $400. If you do an eviction, that eviction could cost you $350, $400, somewhere up in there. Hopefully you don't have to do an eviction. We don't have to do a lot of evictions, but we have to do them sometime. And I always want to know that I've filtered money into an account to take care of that if it needs to happen. If you don't, then this number right here goes right to your profit if you don't have to use it. It goes right to your profit. The maintenance goes right to your profit if you don't have to use it. So don't put it in there and think, well, I'm going to lose them. You're not losing anything. You're just making sure that you can survive on worst case scenario. You're not doing anything other than that. This is going to give you your worst case scenario. If you can live with that number, and then you have no accounting fees. You have no legal fees. You have no maintenance. then that's just money that you make that goes to the bottom line in the end. That's it. I'm from New Orleans, so we're going to call that lagniappe. That's a little bit extra, and you can enjoy it. So if we take all of our expenses, $27,000 on total revenue, and then we come all the way down to $6,700 in expenses. So we add all our expenses up. Our total expenses are $6,700. Our total revenue is $27,900. Now we talked about capital expenditures a little while ago, but it was vague. So I'm going to hit on capital expenditures and what it is. So a capital expenditure is a capital expense that a organization or a corporate entity spends to buy, maintain, or improve its assets. So let's say you go buy a house, and we got a house where we got $254,000 invested in this house, but this house is going to need a new roof in about, let's say, 8 years. I would find out what a roof is going to cost me. I would then divide that number by 8 years, and I would say, okay, I'm going to start putting, $800 a year into an account to cover it for when a roof comes in. When the roof comes up and you got to put a new roof on it, all that money is in that account. You didn't have to pull it out of your pocket. You realized that you had a capital expenditure that you needed to recognize. 5 years, the way I operate is I take all of my capital expenditures, I put them on a 5-year term. So if I know that I got to put an air conditioner in a house, I will start doing a capital expenditure 5 years from the time that I got to do it. I would do the same on my water heaters. I may do a water heater and realize, hey, 2 years from now I got to do it. Okay, let's put a little bit more money in a capital expenditure account and take care of that. So for me, my capital expenditures are usually around $1,500 is where I'll start it. You may look at it and say, well, I don't have $1,500 to pull out of my pocket. I got $500 I can pull out of my pocket. If that's what you can afford, then anything over the $500 that is coming up, you put that in as a capital expenditure. You don't leave it out, and you just put it in there little by little. It may be $50 a month. It may be $200 a year, but you put it in there and you take care of those expenses so that you don't fail. Never allow yourself the opportunity for hard times to come in and wipe you out. Always prepare for it. So capital expenditures are something I didn't put on it. I told you I didn't put a capital expenditure on it earlier, but in my next video, I will have a capital expenditure on the project so that we can look at it and say, okay, how do we handle that? So now we take our total revenue and we subtract our total expenses, and we come up with $21,168. So that tells me I'm going to invest $254,000 cash money. This is not borrowing, this is cash. So cash money. I am going to get a return of $21,168. Now, can you get less of a return than that? Hopefully not. If you did all of your numbers right, you should not get less of a return. You should take care of all of that right there when you figure out your expenses. Will you be able to make more than that? That is a possibility. If your accounting fees and your legal fees are not as high, you can make a little bit of extra money there. If you can find a way to keep your maintenance costs down, you can make a little bit extra there. It's not a lot, but it's a little bit. So you can make more than that right there, but we want to make it where you can't make less. Worst case scenario, as we talked about it, that is your best case scenario so that you understand, no matter what, I'm still good. So what we're doing now is we're going to look at this right here from the cap rate standpoint. So from the cap rate standpoint, we got $21,168. And we're going to take that and we're going to divide that number by $254,000. That's our total investment. So we invested $254,000. We are making 8.3% a year in money. So no matter what, when we look at it, this is what we invested, $254,000. This is what we're making on a yearly basis, 8.3%. That's not a bad return. On an average over a 20-year investment time, this number is going to continue to go up because your rents are going to continue to go up. The numbers will change, but they should not change for the worse. They should always change for the better because we're figuring worst case scenarios in that right there. Now I want to talk about something different. We know that this property is going to yield us 8.3% cap rate. And people look at that and they do real estate investing and they say, well, all I'm going to make is 8% off the year. Maybe you do it and you're making 4%. And you say, all I'm getting is 4%. And you're depressed about that and say, I'm not investing for 4%. And I look at numbers all the time and say, I'm not investing at that number. Everybody's got a different concept on what that number is for them. But let's look at the whole picture. What does the property throw off total as a whole when we're doing this deal calculating through a cap rate? So our cap rate is telling us we're making $21,168 a year off of it. Appreciation. What is appreciation? So if you go back and you Google appreciation for the last 50 years in your area, chances are you're going to come up with somewhere around 5%. I listen to investors say, I never count appreciation in my deal. You can count it in your deal. You cannot count it in your deal. But the hard, cold fact is, if you go back 50 years and you look at what it's done, and it's done 5%, you're pretty safe to use 5%. Maybe this year the appreciation drops a little bit on your properties because we're going through some hard times. But we've been at 20%, 17%, 15% over the last 3 and 4 or 5 years. Our properties have doubled in value over that time. How can we not throw appreciation into our number as we're looking at the deal as a whole? It's part of the calculation. Now, am I basing my life off of it? No. Am I basing my financial decisions off of the appreciation? No. But I want to know that it's there, and I want to know what I'm looking at, because 5 years from now, this appreciation is $12,000, and that is compounded. So where you got $254,000 next year, if it goes up 5%, it's going to go up 5%, and it's going to compound the next year and go up 5% on that 5%. So it is a cash cow in the end, your appreciation. So now we're going to move down to depreciation. The government incentivizes us to buy real estate for rentals because they can't do it all. So they need us as citizens to do it. The government gives us the ability to depreciate our property off over 27 and a half years if it's a rental property, not your personal residence. So if we take and we apply $220,000 to the value of the home, the rest of the money went to the value of the land. We can take that $220,000, we can multiply that by 3.6%, which is going to give us $7,920. So $7,920 will come off of your money. So if you made $50,000, you can pull $7,900 off of your $50,000, and that's what you're going to pay taxes on. So if you're in a 24% tax bracket, that means you don't pay taxes on that $7,600. So that amount of money that it's going to save you in the end is $1,980. So you're going to get $1,980 or $1,900.80 worth of recognized yearly depreciation. So you don't pay taxes on that money. So it may give you a bigger return. It may make you where you pay $1,900 less money. But that is something you get year over year over year for 27 and a half years. So now we add up the $21,000 that we got in cap rate. We add up the $12,700 we got in appreciation. We add up the $1,900 we got in depreciation, and that gives us a total of $35,768 that we made on that property for that 1 year. So we invested $254,000. We had expenses of we had profit of $35,768.80. That is actual, okay? Not speculative. You know what? You can look at what the appreciation was on a home for last year. You can go to Zillow and look it up. You can go to different websites and look it up. They will give you what appreciation is. And you can look at that year over year over year. That is consistent. So if we take the $35,768 and we divide that by $254,000, that's going to give us a 14% return on investment. So if we do the property throw-off, we got 8.3% cap rate. But what that property actually throws off for us over the whole course of the year is going to be 14%. And then the next year, your rents are going to go up, so that's going to change. Your appreciation is going to go up because that's going to change. Your depreciation will stay the same. But the numbers are moving all the time, and they're always moving in your favor. And I'm not going to say always. I can't say that. They are most of the time moving in your favor. Sometimes we'll have a market adjustment. Sometimes we'll have a correction. People are saying we're going to have a big correction now. The big correction that we had in 2008, 2009 was a mortgage correction. There was derivatives that was involved in your property, which we'll get into in another video. And because they did that, that's what caused a breakdown of the real estate market then. Right now, we got 40% of our country don't even have a loan on their house. Their houses are free and clear. A huge percentage of the next 60% have 3% mortgages. Those mortgages are locked in. They're not going up. So if they're not going up, these hard times are not going to hit them. Their numbers are good, and they can trust them. And that's what we're talking about here. This does not take into consideration any forced appreciation on your property. So when you put $254,000 into this piece of property, you might have increased the value of that property to $350,000, $320,000. So if the value of the property went up to $320,000, then that 5% appreciation you're looking at right there, that would be on the $320,000, $350,000, $300,000, whatever $1,000 it went up in value. That's what it's going to be based off. It won't be off of your investment. It's off of what the property is actually worth. So it's a cool thing to look at, cool thing to know, cool thing to understand when you're looking at it as a whole. So the benefit about the real estate investors, we're not looking at making fast money. It's not a gamble. It's not the stock market. We're not putting it in there with hope that it's going up. We're putting it up there and we know what it's going to do. And we know what it's going to do year over year over year, and we're going to pay attention to that right there. And it is an extremely stable investment for the most part, as long as you do all of your research, that you can count on. And this is a 20-year goal, to be a multi-millionaire in this investments. And that's what we're going to teach you over these series of YouTube videos that we're doing. We're going to teach you how to take very small amounts of money and turn that into millions over the 10-year period of time, over a 20-year period of time. All you got to do is do it. We thank you for watching the video. If you like the video, please press like and subscribe. Subscribe to the channel. Let's see what we got coming up next. Tell your friends about us. If you have a question, we're going to provide you with an email at the bottom of the screen so that you can email us any of your questions that you have. We're here to serve you. We're not here because we're trying to make a ton of money. We are here because we have made our money, and we want to give back to the people that are trying to do it on their own now. Thank you very much. Have a great day.